All right, welcome to The Explainer. Today we're diving into a really fascinating part of the investing world, high-yield bonds. You've probably heard them called junk bonds, which, let's be honest, doesn't sound great. But as we're about to find out, one person's junk might just be another's treasure. So let's get into it.
And that really is the question, isn't it? What if this so-called junk could actually be a treasure chest of returns? The whole thing boils down to one of the oldest ideas in finance, the trade-off between risk and reward. If you can get your head around that balance, you can figure out if these bonds have any place in your portfolio.
Okay, so first things first, we got to get past that nickname. What are we really talking about when we say junk bonds? Let's lay out a clear definition.
So, at their core, high-yield bonds are basically loans. You're lending money to a company, but, and this is the key part, these aren't your super stable blue-chip giants. We're talking about companies with lower credit ratings. Maybe they've got a lot of debt, maybe their earnings are a bit shaky. So, to get you to lend them money, to take on that extra risk that they might not pay you back, they have to sweeten the deal. And they do that by offering you a much higher interest rate.
You know, the credit rating agencies literally draw a line in the sand. On one side, you have the investment-grade bonds. That's the safer stuff. On the other side, anything rated BB+ or lower gets tossed into the high-yield or junk bucket. It's that simple difference in a report card grade that changes the entire game for an investor. And this is the main attraction, right here in a simple chart. While a super safe government bond might be paying you, say, 3%, a high-yield bond could be kicking off 7%, or even more. That extra juice you're getting? That's what the pros call the yield premium. It's the reward you get for taking on that risk. This is the treasure part of our treasure hunt.
Okay, so we've seen the reward, and it looks pretty tempting. But now we have to talk about the other side of the coin, the risk. And this is the debate you absolutely have to have with yourself before you even think about buying these things. The list of reasons to buy them is, well, it's pretty powerful. You've got that higher income potential we just talked about. When the economy's humming along, you can even get returns that look a lot like what you'd get from stocks. Plus, there are some diversification benefits and even a shot at capital gains if the company gets its act together and its credit rating goes up. It's a heck of a combo for someone looking for income.
But here's the catch, and it's a big one. The risk that the company just plain defaults, meaning it can't pay you back, is much, much higher. These bonds are also super sensitive to the economy. If a recession hits, their prices can absolutely plummet, just like stocks. And if a company does go under, you might only get pennies on the dollar back from your original investment. So the potential for reward is absolutely matched by a very real potential for loss. So with all that in mind, how do you decide if this is for you? Let's bring this down to earth. For any Canadian investor, I think it helps to run through a quick 5-point checklist of some really critical questions.
First up, and this is a biggie that a lot of people miss, taxes. How does the CRA see the income you're earning from these bonds?
And here's the kicker. The tax man isn't a huge fan. That juicy income you're getting is taxed as interest income. That means it gets taxed at your full marginal rate, the same as your salary. So in a regular non-registered account, they are super tax inefficient. The big takeaway here, if you're going to own these, you almost certainly want to do it inside a tax-sheltered account like your RRSP or, even better, your TFSA.
All right, question number 2. This is a classic concern for every Canadian investor. Most of these bonds are from U.S. companies, so what about that wild ride of the U.S. to Canadian dollar? Does buying a CAD-hedged ETF actually fix that problem?
And the answer is, for the most part, yeah, it does. An ETF that says it's CAD-hedged is built to strip out that currency chaos. It means your return should come from the bonds themselves, not from what the loonie is doing against the greenback. But there's no free lunch, right? That hedging has a small built-in cost, and over the long run, it can act as a little bit of a drag on your total return. Now, this might just be the most important question on the entire list. When the stock market is in a total freefall and everything is bleeding red, are these bonds going to be your safe harbor? The answer is a hard no. And this number just says it all. During that crazy sharp COVID crash back in March of 2020, a popular high-yield bond ETF here in Canada dropped by about 20%. Let that sink in. 20%. That's a stock market number, not a safe bond number. So let me be 100% clear on this. High-yield bonds are not safe haven assets. They are not a place to hide when things get scary. Because their fate is tied to the economy and credit, in a crisis, when fear takes over, they tend to fall right alongside stocks. Okay, number 4, liquidity. Let's say the market's in a panic and you need to sell fast. How easy is it to get your money out?
Now, the ETF itself might trade all day long on the stock exchange, so it seems easy. But the problem is, the bonds inside the ETF can become totally illiquid. Buyers just vanish. It's a hidden risk that only shows up when you need that cash the most, and it can force you to sell your ETF for way less than it's supposed to be worth.
And for our last question on the checklist, let's bring it back home. If you go out and buy a Canadian high-yield bond ETF, are you actually investing in Canadian companies?
Well, here's a really surprising fact for you. Our Canadian high-yield market is tiny. It's just not big enough. So to get proper diversification, pretty much all the Canadian ETFs you can buy in this space are actually stuffed full of U.S. bonds. That means when you buy one, your risk isn't really tied to Canada's economy. It's tied directly to the health of corporate America.
All right, to stop talking in theory and make all of this really concrete, let's look at a real-world example that tons of Canadian investors use, the BMO High Yield Bond ETF, which trades under the ticker ZHY.
So here's the tail of the tape. You can see the cost is about 0.62%. It pays you out every single month, and yeah, in normal times it's super liquid. But I want you to look at that official risk rating, low to medium. After what we just saw with that 20% crash, you got to kind of raise an eyebrow at that, right? It really highlights the gap between a marketing label and what can happen in the real world.
And that really gets to the heart of it. The best way to think about an ETF like this is as a tool for a very specific job, generating a high stream of income. It's not there to be the engine that grows your capital. Its job is to spit out cash flow, and you just have to accept that it comes with a side of stock-like volatility.
Okay, so we've been on a bit of a journey here. We've defined what these things are, we've looked at the good and the bad, and we've walked through a practical checklist for you as an investor. Which brings us right to the end, the final verdict for your portfolio.
So it all comes back to you. High-yield bonds, they offer this really tempting treasure, especially in a world where it's hard to find decent yield. But as we've seen, it is not a free lunch. That treasure comes with very real equity-like risks. Now that you know the trade-offs, you can decide if this particular treasure hunt is the right one for you.